and welcome. I know you're all working on your case studies and or have just finished your case studies. There's some assignment for some comments and discussion about the case studies this week, and then we go on into preparing for your first quest next week. So there won't be new material next week. This is the last new material I'll have before the quest. And then after that, we get a break, which I'm looking forward to. I'm pretty heavily involved with a lot of courses, including this one, and this one's fun. So, but break will bring us back with some freshness. So, spring break starting March 1st, I think it is. And we've got Chapter 5 to go through. We're going to be talking about marketing strategy and marketing objectives. And then we'll go into give you some time to study for the quest, and the quest will be next week. So thanks for listening, and let's get rolling here. So in any strategic plan, we're trying to achieve some objective, a long-term goal, and we use short-term targets to, which we call objectives, to get to our long-term goal. So where are we trying to go? If you think about the case you just finished, where did you perceive that First Show was trying to go? What was their long-term objective? What was their goal? Not their goal for year one, but their goal long-term. Objectives are shorter-term goals. I want to have this much market share at the end of the year. I want to have this kind of profit. I want to have this kind of return on investment, whatever we may have for short-term objectives, but we need that long-term goal as well. And this is true whether we're doing an overall strategy or a marketing strategy for a particular product or service. In this case, at least in First Show, we were looking at a particular product or service and developing a marketing strategy to achieve our long-term goals and our short-term objectives. Whatever those goals and objectives are, they have to be consistent with the strengths of the organization and also what the organization was created to do. So if we're a nonprofit hospital, our priorities are going to be different than if we're Facebook. We're going to have different priorities. So what are we trying to achieve? And then what are our strengths? And we want to do something that plays on our strengths and masks or overcomes our weaknesses. So we did that early on. Remember, we started this, we said, well, we've got to analyze the current situation, and part of the current situation was a SWOT. What are our organization's strengths and weaknesses? And what are the external opportunities and threats? That's the current situation. We can't get to this part of the plan until we've done the basics of the plan. So we've gone through a couple of three pieces. Now we're getting to the what are we trying to do? What is it that we're trying to do? So most organizations, their primary short and long-term objectives have to do with growth. I want to grow. I want to sell more First Show pet food. I want to sell more North Face jackets. I want to sell more pregnancy tests. Whatever we might be looking at. So whatever our product is, we generally have a growth orientation. Not always. We're going to talk about growth first. That's not always the orientation, but it's certainly the most common orientation for most organizations. Growing is easier than being static, and it's way easier than shrinking. I've managed all three types of organizations: growing organizations, relatively static organizations, and shrinking organizations. And believe me, trying to manage a shrinking organization is one of the most difficult and taxing things you can possibly do. Think about coming to work every day as the executive who knows that we're shrinking and we're going to have to conduct some more layoffs. People you know, trust, like, and admire, you're going to have to say goodbye to. Or we're going to have to close locations, or we're going to have to drop product lines. Those are really, really hard things to do. Not a fun place to be, but sometimes necessary. So growth is sort of the default. I'd like to grow, and growth is in many ways the easiest thing to manage because we have more and more opportunities for the people that work for us. We have more and more resources as we grow. So all of those things are good, at least from an organizational or management standpoint. So growth is the default, and there are basically 4 marketing strategies that we can approach any product as a standardized strategy. Now, this doesn't mean that there's not variations within these, but these are pretty standardized things, and we can break the world into these 4 pieces. So we can look to penetrate the market we're in more deeply. So we already are in a market selling something, and we want to get a bigger piece of that market. We can develop new markets. We're in, and this would certainly be First and Show's situation, we're in the dog food market. We are a player in the kennel market, and we're looking to expand to a new market with essentially the same product. So we're going to take our product, which we've had some success with, and we're going to look for new customers. So rather than just kennels and dog show folks using our product, we're going to try to get the average pet owner to use our product. So that's a market development strategy. We're going to develop a new market. And market development can be new markets in terms of users, so that would be First and Show. It can also be new markets in terms of geography, expanding to either other parts of the country we're in or to new international markets. Those are market development strategies also. So those first 2, market penetration, market development, have to do with keeping the same product, or essentially the same product, and finding new places to sell it in terms of development, or selling more of it where we're already selling it in terms of market penetration. Product development is different. Product development, we're going to develop something new. So we've been making dog food, and now we're going to market dog collars. That's a product development. We developed a fancy new dog collar. I think in one of your postings this week in a discussion group, somebody mentioned LED lighted dog collars. Yeah, so we're First in Show, we sell a lot of dog food. Now we want to sell people First in Show dog collars that have some feature, whatever that feature might be. That's a product development strategy. So we've made our mark. Now we're going to sell to new product in existing markets. So we already have a name. We're already selling product to dog owners. Now we can sell them something else. So the market development strategy is what North Face was talking about. We've penetrated a user market that uses our product, and now we want to develop new markets. We want to sell our existing product to new markets, to urban, social, whatever, all of those buzzwords. Or North Face could, to grow, develop, I don't know, start to sell skis, start to sell equipment rather than just clothing. Certainly a possibility. They have a strong brand name. Maybe they could sell North Face backcountry skis, develop a new product that was really good, and market that to their existing customer base. That might be another way for them to grow. And then diversification means getting out of where we're at. we're not going to stay in the same market at all. We're going to sell something totally different. So diversification, we know of a number of diversified companies. General Electric comes to mind. They sell turbines for power plants. They sell jet engines, and they sell medical equipment. Pretty different markets. That's a diversified company. Berkshire Hathaway, the big conglomerate that whose owner gets or whose founder gets a fair amount of press, is a totally diversified company. They own insurance companies, they own furniture retailers, they own Dairy Queen, they own Burlington Northern Railroad. Unrelated, totally diverse companies where they are the owner, the financial owner, but the companies operate in totally different markets. No relationship between Burlington Northern and Dairy Queen that I know of. So different, diversified. So all of those ways are ways to grow. We're here, we want to go get bigger. We can grow by any one of those four strategies, and we can grow by a combination of those strategies too. It's not like they're unique and alone. So I've talked about market penetration, sell more of existing product to customers in existing segments, and build on those relationships. So we've already got a market, people like us, we can sell more of what we do, we can get more people in this market to buy our product. Market development, new segments or markets for existing products, which is really what First in Show is attempting to do or thinking about doing. Product development, sell new products to customers in existing markets or segments. That would be a First in Show developed dog collars, or if North Face developed backcountry skis. Same kind of thing. We sell new products to customers who are already in our existing. So they already know us. We're going to leverage our customer, our product reputation, or our company reputation. And a lot of companies, I didn't mention this in my initial thing, a lot of companies will do that by maybe rebranding because they already have a customer base, rebrand. And one of the things that happened in the markets that I came from, ski boot makers, people like Lang and Solomon and so forth, all had branded socks. So you could get Solomon socks or Technica socks or Lang socks. Why? They didn't make socks. They had somebody else make socks with their brand name on them, and maybe with some features that were unique to them, you know, thin or thick or padded or whatever. Why? Well, I'm there getting fit for ski boots. I need socks. It's a nice add-on sale. And if I'm getting a Lang boot, I might as well get Lang socks. So they're leveraging their ski boot expertise or reputation to sell an add-on sale, socks. So and they're not going to make those socks. They're going to rebrand or resell someone else's socks with their brand name on it. Very common in many, many markets. Diversification, new markets outside of our current markets. We can develop the products internally, we can acquire the products, or we can start up a new business to sell those products. So diversification, most large conglomerates have diversified by acquiring others. So Berkshire Hathaway and Warren Buffett definitely have done an acquisition. They haven't developed them internally, they've bought them. So Warren Buffett saw an opportunity with transcontinental railroads, thought that he could take Burlington Northern and pair it up with one of the eastern railroads like Norfolk Southern or CSX, and then was blocked from doing so by antitrust folks. But he thought, if I buy Burlington Northern and I pair it with CSX, I will create a huge amount of value. Be able to move goods from the West Coast to the East Coast by train without ever switching carriers. His view didn't work out, but he did buy a fairly lowly valued asset, and has increased dramatically in value since he bought it, even though he wasn't able to execute his whole strategy. So pros and cons of diversification. The advantages are it spreads risk. You can explore new areas. You can grow when you're in currently mature markets. So I can grow by diversifying. The disadvantages is I may use a lot of my resources to do that. I may confuse my brand awareness if I choose to use the same name. General Electric uses the same name on all of their products, whether they're jet engines or medical devices. Warren Buffett and his company does not. There's no relationship in the consumer's mind between Dairy Queen and Burlington Northern, even though they have a common owner. So if you choose to use your name on multiple different products, you may confuse the brand awareness. And the biggest problem that happens with conglomerates is loss of focus. Right now, GE is going through some severe financial problems, and part of it was a loss of focus. Their financial arm was growing so fast that they focused on that and forgot about the rest of the stuff. Senior management was not focused on making their manufacturing facilities and their manufacturing processes more efficient. They were focused on making a quick buck in their finance arms because they could make a lot more money there, and so the focus went there. Then, of course, the manufacturing arm suffered, and that dragged down the financial arm. So, you got to keep your focus where it needs to be, and that's a risk. So we've talked about growth, and those are the 4 pieces of growth strategies. Sometimes we're in a situation where we need to maintain, not grow. We want to sustain our revenues or hold on to our market share. We may want to wring short-term profits from products that we see as long-term not having a lot of opportunity or potential. And we may want to be in a maintenance strategy so that we can prepare for future growth. So those are maintenance strategies. And then sometimes we do retrenchment, and we see retrenchment happening all the time. I'll use GE as the example. They're selling off a big chunk of their medical business to raise cash because they're in financial trouble and they need the cash to pay down their debt. So they're leaving one of what has been a relatively lucrative market for them in order to raise cash. That sale should be going through in the next few months, and it's for something like $21 billion. So that's going to help them pay down a significant amount of debt. So we may decide to exit markets by selling off divisions. We may decide to drop products. Ford decided not to make passenger cars anymore. They're only going to make SUVs and trucks. They didn't see a future in passenger cars. They didn't see growth in passenger cars, so they decided to drop passenger cars. That's a retrenchment strategy. Probably lots of resistance within the company to doing that, but senior management said, hey, we have to focus on the things that matter to us for the future, and passenger cars we don't see as having a future. We can downsize our marketing plans. We can limit our distribution, so we can leave areas. We can either leave geographic areas, or we can sell through fewer channels. Or we can close down. Let's close. So growth is not always possible. It's not even always desirable. So we may need to work to be successful while not growing. So I'm not going to grow. We're in the middle of a recession, but I definitely want to hold on to my market share. I don't want somebody else to come in and take my market share. Yeah, we're gonna be flat or down, but let's hold on to the share of the market we have. Or I want to make as much money as I can despite the fact that we're in tough economic times. So what are non-growth strategies? Well, the first one, maybe the most painful one, but one that happens all the time, is filing for bankruptcy. I can't do it. I'm failing. I have to get out. The market is moving away from me. The best thing for me to do is file for bankruptcy. Now, filing for bankruptcy there's two different ways to do that. In either case, we're turning our control of our assets over to the court, over to the bankruptcy court. But we can turn our assets over to the bankruptcy court, and the court can choose to help us reorganize, which means protect us from our creditors and allow us to reorganize and continue to operate. Lots of companies have done that in the recent past. Sears Roebuck, General Motors back in 2008. None are coming to my mind. There's lots of them. Or that's called Chapter 11 bankruptcy or reorganization. Chapter 7 bankruptcy is the court takes my assets and liquidates them, sells them off, and uses the proceeds to pay my creditors. Chapter 11 requires the support of creditors to work, so creditors have to agree, and so what creditors usually get is, in lieu of getting their debts repaid, they get equity in the company, and the existing stockholders usually get nothing. So bankruptcy is a way out. You're seeing lots of retailers do that right now. Barney's the very high-end retailer in New York, just filed for bankruptcy. Not too long ago, Toys R Us filed for bankruptcy. Bricks and mortar retailers are struggling. Their market share is shrinking, and they're struggling, and many of them are failing. So the route out is bankruptcy, either with full Chapter 7 liquidation, which is what Toys R Us did, or reorganization, which Sears did a reorganization. I might decide to just get out of certain markets, leave certain markets. I'm operating in Canada and the US. I'm struggling. Canada is not a good market for me. I'm going to get out of Canada. I'm going to close down my Canadian operation. I can get rid of certain products that aren't either expensive to support or are not generating enough revenue, or where I'm not very competitive. So I can get out of certain product lines. I can which ties into refocusing. I can refocus on the things I really do well. That's sort of what General Electric is doing. They're focusing on power plants and airplane engines, and defocusing on healthcare and finance. I can limit my distribution. I can close a division. So I can limit distribution by cutting out channels, or cutting out regional or geographic locations. And I can also get rid of one division. So if I'm making cars and trucks, I can get rid of my car division and just keep the truck division. So those are all non-growth strategies. Both kinds of strategies are necessary at one time or another. When you're growing, it's easier. You have more options and they're more fun. But managing non-growth is also part of the game, and you have to be able to do that. And both of them require significant marketing strategies and marketing plans. So that's the first half of Chapter 5. There'll be some questions after this, some follow-up questions after this, and then go on to the second half. Thanks very much.